Have we reached a top in the market? I do think a correction is beginning here, but not in the typical sense. There are just a few charts that are starting to show some signs of a slowdown, but nothing is overly bearish. I easily think it could be a time-based correction. So welcome to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we have a small-bodied hammer-esque style bar where certainly in the lower wick buyers stepped up. They were able to push prices back up to the opening print, through the opening print for a close pretty decently in the upper third of the weekly range here. On the bar-to-bar count in terms of location, we absolutely see a substantial higher low as well as a higher high, and the close is a brand new all-time high close. So the buyers go 2 for 2 on the weekly count. Of course, the trend is up. We have lows, we have higher lows, we have highs, we have higher highs, and this, of course, is a brand new set of higher highs in the overall trend count. And just as a general reminder, all of this is taking place over the weekly breakout point, so it's a pretty status quo, bullish-looking weekly time frame chart here, not a shocker. That, of course, we remain above all of the anchored VWAPs here. If we come in with the Fibonacci from the pivot low up to the most recent and brand new all-time high, the 38.2 is now much more reflective of these lows instead of, like last week, being a little bit more aligned with the breakout level. So at this point, ideally, if there was a weekly pullback, it's still over that 38.2, and it is respectful of our anchored VWAP as well off of this pullback low from over here. Not much new to talk about on the volume shelves just because we are moving into blue sky territories, but we'll take a look here. Of course, we're above all of the volume shelves there. We've even closed above this minor pivot right there, so not much to really write home about on the volume profile. We know that from a measured move perspective, really using this zoomed out view on the chart is most insightful for doing something that looks like this, and we know that 610 is the measured move target on the weekly as well as the monthly, coming from the sickness low up to the previous all-time high down to the 2022 drawdown, and you get beautiful confluence at that 610. So once again, the argument's not that we go there in the coming 5 days worth of trade, 10 days worth of trade, the next month, 2 months, but over time 610 is a reasonable level to look at as a blue sky breakout target. Let's drop it on down to the daily time frame chart here, and let's get even more granular and start to see what's going on here. What did I mean by a correction is underway, but it's not a typical one? Well, let's stay status quo, and then I'll show you a little bit of a secret here. So first and foremost, weekly expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 591.65, implying a new higher high in the trend count and a brand new all-time high as well. That, of course, is bullish. And if we're contained by the lower bound, the number's at 577.55. I would argue that this does imply a higher low because you never really sustained an hourly downtrend on that liquidation break day from Tuesday. So generally speaking, what has the market done over the last 5 trading days? It's done nothing more than make a gap and go on Monday and then balance off for the remainder of the week. Now, on Friday's session, we have a simple inside bar, and technically Thursday did gap up. We closed that gap all the way, and we did support over the Wednesday high. Notice that Friday's low is also over that Wednesday high. So to me, there are small signs of progress in the upward direction here, but it wouldn't be unreasonable if the market consolidates for a little while longer. And the reason I say something like this is sort of similar to what happened over here. There was a pretty substantial move in the upward direction, right? We had broken out over this. We saw an advance, and then the market cooled off and sort of consolidated for a bit. And the little secret I was referring to just a moment ago is if we throw on the 20 SMA here, you can start to see that when we extend ourselves from the 20, 2 things can either happen. You can see an aggressive pullback via price and go to tag the 20 SMA, or you can see sideways price action, in which case the 20 SMA typically catches up to price, and it's a consolidation or a correction via time, not necessarily price pulling back and making a big bearish move that freaks everybody out. So I think that after this breakout has taken place right now, or over the last couple of days, really Friday, the end of 2 weeks ago, last Monday, the gap and go sort of added a little bit onto the breakout. But if this just consolidates up here, it's really not the end of the world if we go sideways and allow some time for that 20 SMA here to catch up and then maybe offer a little bit of a next sort of launch point, if you will, in the upward direction. Another reason why I think it would be reasonable for a consolidation to take place is because, as we know, when we break out of a balance range, typically what we're looking for is a range double. And what you'll see here is that we've absolutely hit that measured move target, And if there's some consolidation, some digestion, it doesn't really impact the trend all that much. So sticking to the basics of trend analysis on the daily time frame, I mean, we have lows, and as I said, this is maybe a soft higher low, but we never really flipped into an hourly downtrend here. So where is it possible that we could sustain a daily higher low above? I've moved the level up from 572 to 574.40, which is the 4-day high breakout level from back here. Remember that we also supported for an inside day on Thursday of 2 weeks ago off of that same level. So if the daily chart does pull back and is a more aggressive correction via price, my line in the sand here would be looking for support off of that level. Notice that it is slightly underneath the lower edge of the weekly expected move. I would not consider the trend broken if we found a higher low at that key level here at 574.40. So we've talked a little bit about correction via time. We've talked a little bit about a pullback here, but once again, I want to go all the way back to my original point here on the daily time frame, which was just that the trend remains up. This is absolutely just a soft higher low, and there's really no indication that the bears are being overly aggressive here. Yes, we had a failed gap up to new all-time highs, and by failure, I just simply mean that the gap faded, and we did tag up to that Wednesday high, but recall that I said Friday's low is also supportive of that Wednesday high, and we closed inside of the Thursday range. So I'm not seeing any big bearish evidence that would suggest, oh my goodness, buckle up, a pullback is imminent, we're going in the blink of an eye to 574.40. It doesn't look like that's the case. I would either say that the primary outcomes here on the daily time frame chart should be consolidation in this range for the 20 SMA to play catch up, and then possibly Brigade bolts here into blue sky territories, or just straight up continuation with Brigade bolts up and over the Thursday high of day, allowing us to really effectively manage risk as we're looking for breakouts into uncharted territory. Let's take it on down to the hourly time frame chart and see exactly what's going on here from a more nuanced perspective. I think what we want to do is really think about exactly what happened earlier on in the week, namely the Tuesday session, right? On Tuesday, you did see a liquidation break. We know that the ASML sort of earnings report, the leak there, causes this move to the downside, but look at how the Wednesday session technically moves higher. It's very possible that if the sellers were going to remain strong and cause a stronger pullback in the market, then this should have acted as a lower high, right? If you're thinking about the possibility of an hourly trend reversal, you could have had high, and then you could have had a lower high here at the Wednesday rally. If Thursday had opened underneath, if TSM earnings did not cause a gap up, that would have threatened the possibility of an hourly trend reversal, and it simply didn't happen. So once again, bringing in that sort of sentiment piece from the daily time frame chart, there's really not an overwhelming amount of evidence here that suggests that stronger sellers are really getting active in this market. And notice also that even as we closed the gap on that Thursday session, we closed ever so slightly inside of Wednesday's session. Where did we find support on Friday morning's opening drive to the downside? A painfully slow morning on Friday. But regardless, where did we find support? Technically over that level, over that Wednesday high of day, near the lows of the Thursday session, right? The gap fill reversal. So to me, the pushback in the upward direction is actually more indicative of buyers being somewhat resilient or just not having stronger sellers in the market presently. As of right now, my primary outcomes on the hourly time frame chart would simply be consolidation here, Brigade bolts to blue sky territories, that's holding over 582.75, finding a higher low over 584.65. What's going on with my drawing tool? It's sort of breaking on me. There we go. Some sort of Brigade bolt the blue sky territories is also bullish, and I will change my tone if this does in fact turn into some sort of hourly double top. If we find a lower high underneath 579.75, something that looks like this, absolutely, I think it's reasonable we might come in for a deeper pullback towards that 574.40. But as of right now, given the evidence and sort of the walkthrough that we just did, it doesn't seem as though we have stronger sellers currently present in this market. If we come in with a Fibonacci from the bottom, or the beginning really, of this breakout to the most recent high, notice that your 38.2 is sort of right around a key area here. It was the Friday high that really accelerated the break from this hourly bull flag, and that's sort of where we found support on the Tuesday liquidation break. So as long as we're over sort of that 579.75, this is still just bull flag consolidation in the grand scheme of this looking pattern right here. If we throw on the intraday anchored VWAPs just to see what's going on from this perspective, again, can you say anything bearish about this chart? Not really. Even from the all-time high gap up, which is a gap and sort of fill, right? So to the downside, sellers did have some intraday pressure there. Notice that Friday closes closes above that anchored view app. This is providing confluence here from the breakout day, just like the 38.2 at 579.75. So all things considered, I think that this is a status quo market continuing to grind away in the upward direction. Consolidation up here is fine. This is still healthy. I would look for this over time. This would be even better, as we just mentioned, this and this. Of course, if you're really looking for a clean indication to new all-time highs, let's grab a level here and do this together in real time. We want the open of the all-time high gap up there. Let's go to 586 for round numbers sake. You guys know the rules up here in the penthouse. Round numbers only. So that, again, here, great. Possible longs on this higher low. You could really wait for the confirmation here on this higher low, and it's a blue sky move to the upside. Remember that 610 is a weekly measured move target. Again, the odds would sort of say that it's not likely we get there this upcoming week, but it's something to be striving for in the upward direction. A big failure underneath 579.75 really changes tone, and I would be thinking about a deeper pullback towards this daily line in the sand, which is much closer to 574.40. With that, let's move along to the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right hand corner. And generally speaking here, what I want to talk about is the Thursday gap up that faded to close the gap, right? It went directly to the Wednesday high. Were the market internals bearish as that liquidation was happening off the open? The answer is absolutely not. I mean, volume flows were hardly negative through the entire day's session there. If you take a look at the advanced decline line, yes, it's negative, but were we anywhere close to trend lower zone? The answer is absolutely not. The index score, of course, is always going to be more reflective of where you are relative to the opening print on the day. So that makes sense that that's negative here. But look at the Thursday cumulative build out of the tick across the exchange. And keep in mind that the tick, most importantly, does not have any regard for where you are relative to the previous day's close. It literally measures on the tick by tick data. Was there widespread selling across the market on Thursday? The answer is absolutely not. The tick could hardly even get negative, never mind close negative. So when I look at these charts, right, generally speaking, I think a time-based correction sideways, building out another balance range, building out really another building block. If you just go to the daily time frame chart, if you think of the market in terms of building blocks, another building block up here is absolutely constructive in the upward direction, and there's really no supporting evidence that, oh my goodness, bears are coming out of the woodwork to absolutely flatten this market. Let's take a look not at this screen, but rather the market profile first. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. And simply put, we just want to monitor where is value on this push in the upward direction. So, of course, it's continuing to move higher. Here's Monday, here's Tuesday, Wednesday, highest of them all. And then, of course, on Thursday, we're on the Russell right now. I just realized this is incorrect. I'm thinking to myself, wait a second, Thursday was the gap up. So here we go, rather. We've got value, which was, again, go all the way back to the liquidation break on Tuesday's session. Where's point of control? Where's value? It's really more central than anything else. It was really an isolated incident with bears coming out of the woodwork and semiconductors panicking on that release of the report. As we look at Thursday's session on the gap up, value was still technically higher, even though the gap had closed all the way. Value was unable to shift into the Wednesday range. That's absolutely a bullish indication. And even as we look at the Friday session, it's an inside bar, yes, but value is unchanged. Point of control is ever so slightly in the upward direction. If anything, breaking up and over the Friday high of day should unlock, in theory, thin structure retracement through the A period single prints, leading to a blue sky breakout. So once again, all of the evidence that I can see so far supports more of the bulls remaining in control, or at least the idea that there are no stronger sellers present in this market just yet. Let's get back on over to the platform. Let's reset this and take a look at the nasty Nasdaq QQQ on a weekly time frame chart. See what's going on from this perspective. Here we go. Very similar on the QQQ. You did close red on the weekly bar, but it is still progress in the upward direction. So let's talk about candle structure and location, as we typically do. It's still a hammer-esque style bar, and as we know, buyers stepped up towards the lows of the candle. They were unable to recapture the opening print, though, which I do think is an important distinction here on the weekly bar, unlike the S&P, which closed over the opening print, giving us a green-bodied bar. So it's a subtle distinction to make, and as we've been noting, it's still very clear that the Nasdaq is lagging the S&P 500 without making these sort of new all-time highs yet. However, on the bar-to-bar count, we still get ourselves a higher low as well as a higher high, and a close right at the previous week's high. So not the end of the world. I would be more concerned if the weekly bar closed, more so inside of the previous week's range. It's just not the case as of right now. From a pattern perspective, this is still very much so in play. We're over the neckline of the double top, and as we know, the catch-up trade is ultimately to make it to the all-time high there, closer to 503.25. 485. Generally speaking, there's nothing overly concerning with the weekly time frame chart. It just looks like a slow grind in the upward direction. We can quickly check in on the anchored view apps. The cluster is underneath us, no problems there. If we come in from the Fibonacci low up to the high, 38.2 is over the neckline of the double bottom, so I would just argue that a weekly line in the sand is over the anchored view app cluster, over the Fibonacci 38.2. Not much to really write home about there. Let's quickly check in on the volume profile. And as we can see, it is yet again another close over the high volume node, increasing the odds that we continue to use that as support. It's demand underneath us and possibly pushing in the upward direction. So the higher time frames here are still bullish on the QQQ Nasdaq, even though it's lagging the S&P 500. Let's take a look at the daily time frame chart. Weekly expected move will be our first analysis piece here. So this is the box. If we're contained by the upper bound, the number's at 502.49, implying a higher high, but not yet a new all-time high. It's bullish for the trend count, but not a new breakout. If we take a look at the bottom end of the range, it's 486.42, implying a higher low. I would argue that you had a bit more of a sustained hourly downtrend here. Notice that the Nasdaq had a bit more of a larger move to the downside on Tuesday. Not a shocker, considering there's much more representation of semiconductors in the Nasdaq versus the S&P, which is, of course, a little bit more diversified. Generally speaking, we're still over the daily line in the sand, which is right here at 486, coming from the top end of this balance. But also, if we extend this off to the left, I know it's not literally on the chart that way, but it is the previous pivot high from over here. As long as we're above that, notice that the Wednesday bar was a sort of a beautiful hammer-esque style candle right off of or above that level. It does strike me as bullish. On the Thursday session, yes, a gap up, just like in the S&P 500. It closed the gap all the way. And what I like most about the Friday session, the range was just incredibly small, right? Puny range there. But do notice how it did hold up over, most importantly, the triple top rejection highs from back here and the gap up high from in the past. Once again, that's 493.50. So I would not say that this chart is inherently bearish. We are pulling back technically from the highest high. I would argue that this is lows, higher lows, and ideally we get consolidation that remains above that 493.50. I would be more willing to change my tone in the Nasdaq if there's a breakdown and lower high intraday underneath 493.50 for another pullback into that 486 level here. Let's take a look at the hourly time frame chart just to fully understand this here. Actually, but before we do that, I do want to be congruent and at least bring out the 20 SMA here on the Nasdaq. Notice that we've already tested this, whereas in the S&P 500, on that move lower from the Tuesday breakdown and Wednesday sort of hammer there, you didn't even get anywhere close to the 20 SMA, whereas the Nasdaq is right there, right off of it on that Wednesday session. So just sort of trying to be congruent in the analysis here, making note of the differences between the two big indexes. In terms of the hourly time frame chart, again, you can just see how painfully slow that range was on the Friday session, but it is still over that key level. So I would have to remain more bullish than bearish. If we're over 493.50, I would try to look for demand holds there that rotate up to the top end of this range at 499.50. Anything above that really starts to aim at the all-time high catch-up trade. Once again, that's 503.25, which, as we just saw from the weekly chart, also makes sense. There's no indication of stronger bears here in the Nasdaq unless we get some sort of failure back down underneath 493.50, in which case, once again, I think that this is probably a reasonable outcome, and then you might be able to argue that we have left head, right shoulder kind of over here. But once again, even just put yourself in the shoes of a seller from the Wednesday session. If you're a seller over here and you're seeing this price acceptance underneath that 493.50 all day on Wednesday, I mean, there was attempts to sort of bounce off of these lower wicks, but you didn't really get much follow through. It was TSM earnings that sort of saved the day here. Notice that Thursday even closes back underneath 493.50. If you're a seller, you're basically foaming at the mouth for, okay, show me the lower high underneath, and then this should easily rotate back down here, a breakdown underneath 486. That really opens the door for the weekly breakdown, and it just didn't happen. So even though Friday's range was not impressive at all from the buy side, it's still very difficult to say that the bears have any overwhelming edge here with the sustained hold of 493.50. Let's come in with the intraday anchored view app, see how we make out from that perspective. We are completely above even the gap up anchored view app from the Thursday session. Let's bring this back to what would that have been, Tuesday? Let's just do this together here really quickly. So that was Thursday, this is Wednesday, that would be Tuesday. That is just beautiful confluence with this origin of the breakout anchored view app. So once again, as long as we're over this 493.50, I would really say, there's not much to lean into on the bear side, looking for just straight up consolidation and moves in the upward direction. You could probably say something along the lines of a breakout over 495.25. It's actually quite a beautiful thing that Thinkorswim gave us the nice round number here. I am going to make it a dashed and dim level though. If we can break out over that, that's where I would really think that the trade is on into 499.50. So consolidation, Brigade bolts here, 499.50. Consolidation that breaks down. A lower high is probably worth entertaining possible pullbacks that look like this. I would really want to see the S&P 500 also weak if that's the case, and likely semiconductor weakness as well. Big failures out of NVIDIA. AMD has sort of been weak relative to NVIDIA recently, but just the semiconductors really failing if this is going to play out like this to the downside with the lower high and larger move to the downside. Let's come in with the Fibonacci's just to ensure that once again we are congruent with the analysis. Low to high, 38.2 is right there. So just reinforcing that 493.50. Not much else to say about that Nasdaq chart. I think you can all tell where my focus will be in terms of the first key level in the upcoming week. Nasdaq market internals looked decent on the Friday session, although it was a sideways session, not really doing much of anything impressive here. Volume inflows, we were positive out of the advanced decline line. Really flat on the cumulative build. So again, have to sort of keep a level head on the analysis here and just say, okay, at the exchange level, there wasn't a whole lot of euphoria. Obviously, it was an OPEX, so it's very possible that there was just a pin into the end of the week, trying to let some options expire, and then we'll get some more volatility as we head into the early stages of this upcoming week. Let's take a look at the market profile of the NQ. I'll make sure we're on the right contract this time as we start the analysis. So here we go. We certainly have value that progressed big time in the downward direction on Tuesday, leaving all of this thin structure overhead. The one thing that you might take away from this is just simply the fact that even on the gap up from the Thursday session, there was no full thin structure retracement to come back up and tag the high of that Tuesday open. So you might argue, okay, buyers are not really doing their job. In a picture perfect world as well, we all know that the best the best look for the Thursday gap up would have actually been a hold over the previous triple top highs, right? If I do something that looks like this, you can see the previous triple top highs, which we talked about on the QQQ daily time frame chart. The best move on the Thursday session would have been an open above that supports above that would leave some of the gap unclosed, obviously. Therefore, the sellers would not have been deemed strong there. That would have been the best outcome. Obviously, it didn't happen, but once again, with the Friday consolidation right at the level, I'm still hard-pressed to say anything overly bearish about the Nasdaq here as well. It's a pretty status quo market right now, continuing to grind away in the upward direction. Let's get back on over to the platform here and finish up the broad market analysis with the Rusty Russell IWM on a weekly time frame chart. What do we see? Let's give ourselves a clean drawing set and take a look. So first things first, candle structure is much different from both the S&P and the Nasdaq. A little bit stronger of a green body, my apologies, green-bodied bar. I don't know if you can tell, I feel like I'm going a million miles an hour today. I had a double shot of espresso in my latte. Man, am I feeling it. But we've certainly got ourselves a stronger close in the upper third of the weekly range. Much more range expansion in the upward direction as well. Yes, a little bit of an upper wick, but nothing to the degree where I would say, oh my goodness, sellers are stepping up. This is a nasty inverted hammer, duck and cover. It's got to be bearish. Not even close. Bulls are in control structurally. If we think about location on the bar-to-bar count, we also have a clear higher low as well as a higher high, and it closed completely outside of a number of previous weekly ranges, even above this upper wick as well. This does strike me as solid progress in the upward direction. If we zoom back out, it is fair to say, let's grab even more time than 3 years. Seems kind of crazy to say, but the chart sort of is starting to resemble more of a cup and handle. And if we can break out over this handle high, I think it's a clear shot into all-time highs, or at least to test the all-time high, if not blue sky breakouts. And just remember what that means from a recession probability perspective, right? If small caps are outperforming, what would that sort of indicate about the perception from investors in terms of risk, right? Obviously, if everybody believed we were headed towards a recession, you probably don't want to be in small caps, highly reliant on, American consumers, first of all, but also very sensitive to financial conditions. The chart does not really seem to be overly indicative of that. If we're looking at simple moving averages, not that I'm a big fan of this, but we've sort of gotten a golden cross over the past couple of weeks here. Again, slightly more bullish than bearish. This has not even been a talking point for the S&P and the Nasdaq because you've always had the 50 over the 200 in the more recent trading action, but that is noteworthy here out of the Russell. Let's drop it on down. I mean, we can talk about, let's do it. Let's just take a look here at the weekly anchored view apps. You're holding up over the entire cluster, sort of using these as support over the past 3 or so weeks. That makes sense to me. If we bring out the Fibonacci's from the bottom of this up to the most recent high, you're over the 38.2. So pretty status quo stuff here. One thing we can throw on is the volume profile, because this is slightly different when we're dealing with the Russell. We're trying to launch away from this high volume node. And once again, you can see that if we can kind of clear this handle high, it's really not much in terms of volume resistance. The all-time high is literally the only structure that we would have to deal with up next. So just keeping that in the back of our heads when we're thinking about small caps here. Let's drop it on down to the IWM daily time frame chart. We'll firstly begin with the weekly expected move as always. What do we see here? Upper bound is at 230.06, implying a higher high and a break of the weekly pivot high. That would be a breakout of the handle we were just referring to. And the lower bound is here at 221.26, implying a big time higher low in the trend count. So all things considered, bullish on the expected move. I mean, you've certainly got lows, higher lows, highs, higher highs, and higher highs in the trend count. I would make the argument that you've got a 3-day balance happening here. These are all inside bars on Thursday and Friday. Even if you break down, there's plenty of opportunity for a higher low pullback to be found over 221.75, or my line in the sand is actually going to be the top end of this balance range, which formulated somewhat of a double bottom here. You could say test 1, test 2. Over the neckline, you could call it a daily balance range, whatever you want to call it. That's 219.25. As long as you're above that on the daily chart, I think from here to here, you have a very reasonable and respectful higher low in the trend count, especially when pulling back from the highest high. If you just get straight up continuation or consolidation over 225.25, I mean, what else do you want to say other than just a bullish tailwind for the S&P 500, likely continuing to put pressure in the upward direction for the blue sky breakout to continue in the S&P. Let's drop it on down to the hourly time frame chart, see what else we can learn here. The only concern I have about this is that typically, rallies that are straight up are typically thin structure on the way back down. So if you do breach the 225.25, I wouldn't be shocked if this move happens sooner rather than later, just because there's not a lot of push and pull. There's not a lot of, sideways consolidation to confirm, okay, this is a solid support before the next move higher, so on and so forth. So again, the argument's not to say that the Russell is bearish, but I do think if you break down from this, it's very possible that longs late to the party act as overhead supply. You get some liquidation breaks and you come into that 221.75 sooner rather than later. And it's not really, I wouldn't expect a slow grind to the downside where this thing just sort of like chugs along for a number of days and weeks at a time. I would really expect what goes straight up can possibly come straight back down to test for support at 221.75 and once again 219.25 as your daily line in the sand. Continuation to the upside is pretty straightforward. If we do clear the weekly pivot high, which is that 228.60, if I just go back to the daily chart, it's this level from back over here. If we clear that, the next major level of resistance overhead is way up above at 237.50. Just keep that in mind. Once again, this is not a forecast that we're going there over the next 5 trading days, but it's something to be striving for if we get continuation in the upward direction. Quickly taking a look at the intraday anchored view apps just to once again be congruent in the entire analysis here. The only concern is that you're just chopping through the anchored view app from the Thursday session. And keep in mind, Thursday did not gap up out of the IWM small caps. That was the retail sales morning. It's really more of a flat open, almost unchanged from the previous day's settlement. If we bring out the Fibonacci's just to check in on the pullback areas from low up to the high, the 38.2 is loosely around that 221.75. I do like that the 61.8 is direct confluence with the 219.25. As we all know, the 61.8 is always the line in the sand Fibonacci. The one thing that we didn't do to stay congruent, I know we're sort of jumping around a little bit today. It's a high energy sort of video recording today. Here is the 20 SMA. Maybe over the span of this upcoming week, it catches up with that 221.75, reinforcing the idea that, hey, maybe that could be your pullback low for a higher low in the trend count, keeping small caps absolutely more bullish than bearish. Where would I have larger concerns about things really deteriorating in small caps? Underneath this level. You'd really have to get underneath the 215, and then I would say, okay, probably bigger issues, bigger cracks in the armor starting to emerge out of smalls. We're just not even close to there yet. Let's take a look at the Russell internal, see what's going on from this perspective. Here we go. What do we see on the Rusty Rut? Not as strong volume inflows on the Friday session, which is fine because we were really just more so sideways there. Versus the Nasdaq, which was also sideways, but you had bullish underpinnings, right? On the Thursday session, a little bit more sideways, slightly negative. Wednesday on this break here, a little bit more constructive to the upside. Same thing here, and same thing here out of the cumulative build. Everything else, really just understanding that Thursday and Friday were inside bars. I'm not overly concerned or reading into any of this here or here. really all that much out of the Russell internals. Let's take a quick look at the market profile of the Rusty Rut and see what's going on from this perspective. Again, with these inside bars, you have overlapping value. Point of control did shift lower, so and you also have a very poor low on that Friday session. If we just zoom in here, you can see that there's a real lack of material excess on the low of Friday, even on Thursday's session as well. So breaching this area underneath the 2-day lows, breaking down from this consolidation, which is identical to the analysis we just performed on the candlestick chart, right? We said that you could probably see a snappy move in the downward direction. That would make sense if we needed to repair this and if we needed to repair this. Once again, value is inside with a point of control slightly shifting in the downward direction. Maybe the argument is that you're getting a little bit top heavy here out of the Rusty Rut. Let's take a look through the sectors and see what's going on from that perspective for our S&P 500 as we're just sort of sitting here and consolidating near all-time highs. Here we go. The weekly performance of the sectors is as follows. Real estate is outperforming up 3.28% on the week, followed by utilities, followed by materials. All of those are lightweight sectors, and notably utilities are D for defensive as a posture. At the bottom end of the barrel, it's the semiconductors ETF down 2.71%, followed by energy and then healthcare in here. Semiconductors not directly an S&P sector, but it of course is more of a bullish posture-wise sector or industry, if you will, for the marketplace. Even the XLK, the tech sector, the heaviest weight risk-on sector for the S&P directly related, is down 0.59% on the week. Let's check in on the structural chart. So posture, not really great as we're consolidating here. I would want to see that posture change if we are looking for follow-through into blue sky territories. I'd like to see a catch-up trade out of semiconductors, out of the tech sector, and I'd like to see financials continue to remain strong here. The only issue with that is that financials do look like they could pull back. We'll talk about that in just a moment. Let's begin with real estate, though. What do we see out of real estate? Certainly some sideways consolidation as rates have really gone up. I'm kind of surprised that real estate is acting the way it has. I mean, rates have been substantially higher since the first cut back in September, so I don't know necessarily that this is sustained, but as we know, it's such a lightweight sector for the S&P. I'd be more willing to read into the analysis if we were making a new pivot high or a new pivot low. As of right now, in this midpoint, not really concerned. Utilities pushing to new all-time highs. Once again, this should not be the sector that's leading the S&P to new all-time highs. So posture-wise, this chart does strike me as a slight concern, watching out for utilities. What I would say, and like the actionable takeaway from that analysis, is that if utilities break to an all-time high and the S&P is trying to break to an all-time high as well, with semiconductors and tech not moving in the upward direction, if the utility sector is the only sector pushing this higher, pushing the S&P 500 higher, I really would not trust the breakout there. I would not be a new buyer at all-time highs. I think the risk is just too substantial, right, with the laggards being semiconductors and the tech sector. Let's move along to materials, also a lightweight sector pressed into the all-time highs. So don't get me wrong, upward pressure is upward pressure. Materials are certainly not D for defensive. It would be bullish for the market, but again, it's just the lightest weight sector. So is it going to move the needle? Probably not all that much. Financials, on the other hand, I mean, great breakout. Let's call it for what it is. Huge breakout of an ascending triangle here on financial earnings. Banks reported killer numbers. You got this strong break in the upward direction, but is it starting to get a little bit top heavy? A little bit. The first inverted hammer here did not yield any break of its low, but notice on the Thursday inverted hammer, Friday session absolutely broke its low, and now you have, people would classically refer to that as a hanging man candle. I'm not in that camp. I would still argue that it's a hammer candle, and, it was a failure from the sellers to really close weak on the lows, but is it possible that it's at least a sign of some slowdown here, some sellers starting to step up? Sure. And even if it does pull back, I mean, structurally, there's plenty of room for a higher low over 45.75, something that looks like this over time. But if this pullback does take place and we're still seeing weakness out of semiconductors and tech, and utilities are driving the S&P to a new all-time high, once again, that specific situation right there is not an instance where I want to be trusting of the all-time high breakout in the S&P 500. Utilities should not be pushing the market to a brand new all-time high. Next up, we've got XLY, consumer discretionary. It looks fine. It would be best if this could really get in gear a little bit more firmly up and over these balance highs to produce an equal high at 202.60. As of right now, we're just not seeing that. I would not call it bearish, but it's certainly not helping the bull case. You need to see a little bit more acceleration here out of discretionary. TLT bonds are sort of all over the place. I would really keep an eye on bond and interest rate volatility. Interest rate volatility is typically not a good thing for the S&P 500. You're going to get increased volatility in the S&P, the VIX, and the MOVE index. If you want to track bond volatility, it's MOVE, the MOVE index. Not generally a good thing. So as this sort of looks more volatile with the crazy upswing, downswing here, Again, I think it's reasonable that your S&P 500 might cool off a little bit or feel a little bit of a correction via time. You could get some wild intraday swings. Friday obviously was not an example of that with the OPEX, but you get the idea. Some volatility in bonds probably puts a bit of a pause on a continuation rally in the S&P. Let's move along to the XLP consumer staples. Not much to talk about here. It's in the sweet spot in this consolidation, remembering that it is D for defensive. If it rallies, great. Upward pressure is upward pressure. If it breaks down, not the end of the world because it is defensive. I would be more concerned if it makes a new pivot low. We're not there yet. Next up, XLI Industrials, 8% of the S&P. Looks like it could possibly break out to a new all-time high. It's a medium weight sector for the market, so sure, that would be bullish pressure for the marketplace. I'm not really seeing big concerns out of this chart. Communications look okay here. Honestly, would have expected a little bit better of a move on Friday with Netflix earnings there, but not really the case. Regardless, you're sort of trying to stay over these breakout highs. If that's the case, upward pressure is upward pressure. This is a heavier weight risk on style sector. Next up, we'll take a look at semiconductors. This is where we have to have a real honest conversation with ourselves. What is this starting to look a little bit more like? Well, obviously, the past 4 trading sessions are all red, right? There's been no intraday activity over the opening print, even though, yes, you gapped up on TSM earnings on Thursday. It faded all day. You could make one positive argument, which is just that the gap did not close all the way. Maybe that's slightly more bullish than it is bearish. However, if we're being honest and transparent and having that somewhat it's not a difficult conversation. Who the heck am I kidding? It just is what it is. But this is possibly a right shoulder, right? The failure back down underneath this breakout point. I mean, if you're a semiconductor bull, absolutely, you wanted to see price acceptance on this breakout here stay over 255.70, and we're not seeing that. As a matter of fact, on TSM's earnings gap up, you actually rejected that level. So really not the strongest display of strength. The only counter argument that could be bullish here is that you still have lows, higher lows, soft higher lows, higher lows, higher lows. It's possible that staying over 245 keeps the uptrend intact because you are pulling back from the highest high. But I would start to, feel much better if the SMH semiconductors were over 255.70 again, trying to close this gap overhead. As of right now, it certainly does not look like that is the current case with the weakness on Thursday and Friday. So just watching 255.70 very closely into the upcoming week. Can we get above it? Can we stay above it? Or if we remain below, I would start to say once again, it's very likely you could see some consolidation and cooling off in your S&P 500. Next up is the energy sector. What's going on over here? Big gap down earlier on in the week, yet to recover from that. Obviously, we know that crude, if we take a look at the CL, saw an aggressive push in the downward direction back underneath that $72 a barrel mark. So, a lot of volatility here, honestly, out of crude. If this finds a lower high underneath, the general monthly or even weekly trend remains down. It's just a matter of sort of, if you're a trend line trader, you just want to see a break of that trend line, and you're probably going at least to the equal low here at 66. Maybe that's a little bit counter to our argument in the small caps that recession fears are sort of being dialed back a little bit. If there's not much global demand for oil, we know that this was sort of supply side shocks, if you will, global geopolitical tensions. If this is just straight back to the downside, then okay, it's not like we had, a reimagined demand over here. It was more so, okay, supply concerns. Now that this is back to the downside, does it speak to demand concerns, right? Are we seeing that global slowdown, right? Obviously, GDP still remains somewhat elevated, but that's possibly something to be thinking about here out of crude. The only way that you could turn this on its head and say, like, no, this is a good sign for the market, is to say that you're still just not going to get energy inflation, and the CPI print in the next go-around is probably going to remain, better than the expectation because energy did not remain inflationary on this breakout back in the upward direction. So could sort of see that going either way right now. You can sort of pick which argument you prefer and what makes the most sense to you. I'm not going to read into it too much for the broad market. I think we'll just take it one report at a time if we're gauging inflation and really the demand side for a recession. I'm going to use small caps much more firmly than I would crude. That's just my own personal opinion. Let's take a look at the XLV healthcare sector. Let's see what's going on from this perspective. The third heaviest weight sector by market cap, just like the XLP, it's sort of in its sweet spot. It's fine if it wants to break and do something that looks like this. You have inverted head and shoulders over the neckline, probably sustains the S&P 500. That's not what we want. A little bit of a software update. We're all set on that. So anything that looks like this is A-okay, bullish pressure for the S&P. And if it breaks down, I would just really want to see a slow grind. I wouldn't really want to see this large red-bodied bars directly into the 148 zone. I would really want to see a slow move here as we work our way through earnings season. If this is an aggressive downside move, I would be a little bit more concerned for downside pressure and more of a price correction, not a time-based correction in the S&P. XLK, the moment everybody's been waiting for what's going on with the tech sector, the heaviest weight sector of them all. Notice that we're over the breakout point. So unlike the SMH, semiconductors, once again, are not an official S&P sector. The XLK, of course, is. It's the heaviest weight, most important sector. What do you notice here? I mean, let's just be honest with ourselves. Breakout level, breakout level, breakout level is acting as support. Very classic Brigade bolt right over the level. Is it possible that we see this rotation into the all-time high? Absolutely. As long as price remains over 228.15, I think that there's not a single bearish argument to be made, and over time we're looking for this rotation. It's just a very clean stair step in the upward direction using previous resistance, resistance, resistance as newfound support. Beautiful hammer there on Friday right off of the level. Thursday's gap up. The fade, is fine. It's technically gap fill reversal in here. Friday's an inside bar. I think that we're okay out of the technology sector as long as we're over that 228.15. Consolidation is great, looking for follow through. If we do pull back a little bit, I'd still give it even 224.75. Anything under 224.75 like this, let's call it for what it is. Left head, possible right shoulder. So we're just not there from a reversal pattern perspective. You'd have to see the right shoulder before you would say, okay, buckle up. The tech sector is absolutely reversing in the downward direction. As of right now, this, of course, remains in a firm daily uptrend. Let's quickly check in on our ratio grid and see what's going on from this perspective. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The XLK sector, relative to the S&P, is still sideways over a now curling up 50 SMA. This does strike me as bullish. We'll put a check mark. Financial is obviously outperforming with the earnings reports that have been coming out. XLV is D for defensive, so I'm not overly concerned with this rotation over here. And I'd love it if the XLY could continue to hold the 50 SMA. So for now, I'll just sort of put a neutral tilde here. We are pulling back from the highest high in the trend count. So, sort of maybe a bullish up arrow on the end of that tilde, but I'd say like 2.5, maybe 3 out of 4 are leaning bullish up here, which again, the D for defensive sector doesn't even want to lean bullish. So probably more of a risk on environment right now as compared to a risk off environment. If you take a look at the industrial sector, also higher here and a nice uptrend. Again, industrials are not inherently risk off. So that does strike me as being fine and positive. Communications, be better if it could get in gear a little bit. Let's take a look at the risk-off pieces of the pieces of the puzzle. You've got consumer staples moving lower. That is a non-issue. You've got the utility sector kind of moving sideways in here. I like the fact that it has not gone on to produce a new higher high. So far, once again, leaning a little bit more risk on as compared to risk off. Let's take a look at some specialized ratios, which will help us with these arguments. Pointing in the upward direction, trend is up. That's risk on. As we take a look over here, we've been a little bit somewhat concerned about this, but if this can hold, the retest of that trendline break can hold for a possible higher low 1 to 2, A to B, if you will. I'll give it the benefit of the doubt, so we'll go neutral tilde with a small up arrow here. If we look at consumer staples relative to consumer discretionary, still holding these gains over here, that does strike me as risk on. And what if we take a look at semiconductors versus the healthcare sector, still pointing in the upward direction, still trying to find somewhat of a higher low here. Ideally, it goes on and continues to produce a higher high, so we'll say neutral with small up arrow here. Generally speaking, this probably leans slightly more risk on than it does risk off. If we look at emerging markets, trying to hold a higher low after the China stimulus breakout, once again, probably more of a risk on environment for global equities, even if that's how we're trying to gauge sentiment right now. Let's continue along to our dollar and see what's going on from a more fundamental perspective. Really strong breakout in the dollar, and which is kind of odd. I mean, it seems very technical to me off the bottom end of this multi-year range here off of the 101. Some people arguing that this is currently pricing in a little bit more of a Trump victory in November. We'll see. We'll see how that plays out. But for now, just thinking about what it means for financial conditions, kind of tightening financial conditions here a little bit, which makes total sense if we're looking at, we'll take a look at, let's go interest rates first. Speaking of financial conditions, obviously moving in the upward direction, tightening financial conditions here, unwinding some of the expectations of the full 150 basis points worth of cuts that the market was pricing in ahead of the September meeting. Jerome Powell sort of walked things back. We got the labor report, right, which was fine. So unwinding some of that, tightening financial conditions, which once again strikes me as odd that real estate was really outperforming as the 10-year was relatively stable and remains elevated, but neither here nor there. So we know that financial conditions are tightening. The other thing we could take a look at here is gold. Gold actually started to outperform the S&P slightly as it's continuing its breakout into blue sky territories. This is just an absolutely monstrous, we've been talking about this for a while, an absolutely monster cup with handle breakout, right, on the monthly time frame chart here, just continuing to accelerate in the upward direction. The fact that you're getting some outperformance, if I just reset this out of the ratio chart, again, I would not say that we have a flight to safety just yet until we breach up and over these equal highs. If we were to print a new higher high out of this ratio, then yeah, I might be a little bit more concerned about the market pricing in wave 2 of inflation and being a little bit more skeptical of the S&P 500 continuing in the upward direction. As of right now, if it's just underneath or making equal highs, I'm not sold on the case that, oh my goodness, this is a flight to safety. Let's quickly check in on the inverted ZT. I know we're flip-flopping between rates and gold and currencies and whatnot, but it's staying elevated up here, so pretty much unchanged on the Fed tracker tool would be my guess. If we take a look at this real quick, let's give this a second, a little refresh. There we go. Probabilities, yeah, unchanged over here, not much to write home about. You've got still the market pricing in higher odds of a 25 basis point cut, none on the 50 basis point cut, and some odds of a pause. We'll continue, well, actually the most interesting thing as we take a look at the economic calendar, so this upcoming week, there's really not much to talk about. I mean, there's some talking heads here, Kashkari, Schmid, Daly, who else? I mean, BRICS Summit is going on, Bowman, Barkin. I'd say the biggest deal is probably your PMIs on the Thursday session at 9:45, 15 minutes after the market opens. We'll continue to watch unemployment claims. This previous week, we hit the number right on the head at 241,000, sort of ticking lower from the big uptick. This, of course, was weather-related, longshoreman strike-related, Boeing strike-related. So right at the expectation this week, moving back in the downward direction, seems like a positive step in the right direction. But really Thursday, this upcoming week, is the biggest day from a economic news perspective. And then beyond that, it's really the last week of October and the first day of November that's going to matter. It's the labor report week, right? You're going to get JOLTS, ADP non-farm. You're going to get GDPs here for the first go-around of the next quarter. PCE comes out. Oh, I didn't even realize they were mixing in PCE here. The ECI, unemployment claims. And then on Friday, November 1st, it's the big day for the full labor report, of course. We're going to really, really have to watch what happens here and here to see how ultimately the weather-related events and the strikes have impacted the unemployment rate. I wouldn't be shocked if there's an uptick there from what was previously, if we take a look here, 4.1, right? If we go from a 4.1 up to something like a 4.2, it's really not all that aggressively changed from what we've seen in the past. So, 4.2, it's really more stable than anything. I would start to get concerned if we're printing like a 4.7, 4.8. It's like, okay, very, very difficult to put that back in the bag once those layoffs potentially start impacting and having some staying power, right? It's about the staying power and the continued unemployment claims that matter most. If you're seeing people just get jobs almost immediately after being laid off, not really the end of the world, which is why we're watching the continued and initial claims every single Thursday. You can follow us on X. We post the breakdown every single time it comes out. As we look to the earnings side of the market, let's go ahead and take a look at this. Was the most interesting thing right here. The EPS growth from the consensus of analysts right now for Q3 of 2024 is pricing at about 18.1% earnings growth in the Magnificent Seven companies, and all 493 other companies, which, keep in mind, there's actually 501 companies in the S&P 500, might be 502. Sometimes it's like very, very slight, there's like 2 or 3 extra in there. Anyways, the other companies only producing 0.1% earnings growth year over year. So just kind of a shocker to, number one, illustrate that the beauty of a sort of ETF that's weighted like the S&P 500 is that you get to participate in these gains. Now, of course, the downside is if there's a miss in those Magnificent Seven, then of course you also get the pain of participating in the not meeting of expectations, right? And the lack of other things to follow up and sort of keep prices elevated. So just pointing that out, obviously bank earnings over the last week and a half have been incredibly strong. I want to scroll to the very bottom of this report to just point out as we approach the bottom. Here it is, that earnings estimates bottom up for the full calendar year are continuing to slide in the downward direction. So what does this mean as the market's been rallying in the upward direction? It just simply means that we've seen a multiple expansion, right? If we scroll down, you can even see over here, Q3 earnings are expected to come in underneath Q2 earnings, and yet the market's trading at new all-time highs. Again, what does that mean? Simply that the multiple expansion here out of the PE ratio is totally baked in based on the premise of Fed rate cuts, right? Easier financial policy. Now, what did we just talk about on the 10-year interest rate. If rates are going to stay over 4% on the 10-year, which is very possible, right? The Fed has basically said, let's go through this exercise really quickly. The Fed has basically said that, it's reasonable that the terminal rate for the 2-year might be somewhere around, mid threes, something like that, right? So if we go on over back to the platform here, let's take a quick look at the 10-2 curve. So if that's the case, and the 10-2 curve typically has some, tops out in here with, let's just use round numbers, right? 2 as the added differential between the two, that probably means that you have a 5% 10-year, if the 5.5% 10-year, if the 2-year is going to sort of bottom out around 3.5 or something like that, and the neutral rate is going to be higher than it ever was before, right? We're not going back to ZERP, basically. So just think about what that means for that earnings multiple, right? As we come back here to the PE ratios, I mean, is this an accurate reflection of where this should truly be, especially as earnings are dropping in the downward direction? Now, you guys know me. I'm going to let the charts always guide the decision-making process. I'm not going to short the market just because I believe that this is like inherently bad or, oh my goodness, it's impossible that the PE ratio remains this elevated for so long. I'll let the charts tell me when it's time to short the market or at least sell some longs by flipping into a weekly downtrend, but it's something to consider here as we're just thinking about that, right? So generally speaking, that's somewhat where my head's been when we're thinking about this most recent rally and sort of just pinning it against the backdrop of the PE ratio looking pretty healthy and pretty strong here, even as rates are moving in the upward direction. Earnings this upcoming week, who do we have? Let's see. Of course, Tesla just jumps off the page as a really strong watch here. Anything else? I mean, some classics. Probably worth watching Boeing, maybe Coca-Cola, the dividend king. IBM's an honorable mention here. Maybe 3M, Raytheon if you're into the warfare stuff. Canadian Rail might be worth watching out for. You're also going to get Lockheed Martin. I mean, there's some honorable mentions, but you're not fully into the Magnificent Seven yet. Tesla, I would say, is the biggest deal, especially because of the way that the Tesla daily chart is sort of developing right now with just this sideways balance after the robo-taxi event, of course. What else? UPS, like FedEx, will probably have some interesting comments about the global demand for shipping and so on and so forth. That's really all I'm seeing here that's really going to capture my attention. Maybe Lam Research. I know G in the chat was calling out for Lam Research probably being important. Lam Research went through a huge split and is no longer trading at that massive price point. So we'll see what happens with that. But I would say Tesla is your biggest watch this week on the earnings front. Let's finish up the analysis for today's session. Going back on over to the platform here, we'll take a look at the TLT ratio to the S&P continuing to drift in the downward direction. That's more risk on for equities. Bonds, trying to catch a little bit of an uptick here. I think that this is the bond market pricing back in that, okay, the neutral rate of the shorter end of the curve is probably a little bit higher than we thought, and seeing a little bit of an uptick there as people maybe come back in. We saw this on the inverted ZT, right? The huge pushback to the upside and the consolidation. That's really what you're seeing reflected here in these relationships. Not necessarily bearish for the market down below. What's worth calling out is maybe this uptick on Friday out of credit spreads here on the longer end of the curve, IEF LQD. So maybe that's worth watching a little bit, but I would not argue that this is an, oh my goodness, markets are going to go through this massive volatility event. Not the case as of right now. As a matter of fact, when we get into the vol indexes, we'll actually see that volatility is decreasing. As we take a look at the HYG, it's still in a bearish divergence here relative to the S&P down below. You could say the same thing about the LQD, still sitting on this, still down here. This equal low probably does lean a little bit more bearish. And once again, I think it aligns with the general thesis of today's episode, which I don't want to stray too far away from. I mean, there's nothing bearish about the indexes themselves, but it wouldn't be unreasonable if after the breakout from the multi-day range that we were just talking about in the S&P at least, after the breakout of this range, another period of consolidation or some sort of cooling off, letting the 20 SMA catch back up, is totally reasonable as you have a bearish divergence like this in the LQD and the HYG. Let's move along to, of course, everybody's favorite. Here's Bitcoin, and I've got an interesting little add-on for you here on the bottom. This is the This is the Saylor shift ratio, which compares Bitcoin to gold and then tracks the rate of change in that ratio. And it fires a bullish signal when you cross up and through the zero line, a bearish signal when you cross down and through the zero line. And as of right now, the talk of the town, and I'm not claiming to be special for seeing this, everybody and their sister's brother's mother can see this. Let's just grab ourselves plenty of time here on Bitcoin. Everybody knows that there's this massive cup and handle cup right here with handle. Everybody's watching the breakout, and the measured move is from the bottom of the cup to the top of the cup. If you stack that from the pullback low, it gives you a rough estimated measured move of about 110,000. And actually, on the Thursday session, was it? Thursday, I did add to a longer-term Bitcoin position, looking to see if we can capture this move. I think it's an asymmetric opportunity here with a stop underneath the handle low, the measured move up at 110. I think it's a risk worth possibly taking. Ignore this monthly rate of change as we're just sort of in the consolidation. The tool was really designed to work on a weekly time frame chart here, which you can see is positive right now. If you're interested in this, by the way, it is available on our site. And a huge shout out to Michael Silva over at Figuring Out Money, who had, I don't know if he invented it. I'll give him credit if he invented it, of course, absolutely. If this is his invention, sure. But loosely, I think he's the one that's promoted it. If he invented it, again, absolutely all credit to Michael. But we've just sort of coded up this script for Thinkorswim, so it's readily available. It's not so straightforward. You can't just apply the ratio and then have a rate of change study on it. It's got to sort of be a custom script here. So that is what we've got going on here in Bitcoin. And once again, I think the opportunity is there. This does strike me as a risk-on opportunity. Everybody is talking about it. Everybody can see it. And the big sort of powerhouse understanding is just that, okay, if everybody from the technical side is talking about it, I would make the caveat that you're seeing technicians, you're seeing people who are regularly exposed to the market talk about it. You have not seen massive retail adoption of the, oh my God, here we go. Here's, Bitcoin Breakout 3.0 or whatever version we're on right now. Once you start seeing like CNBC talking about it, once your buddy from, college texts you and says, hey, have you seen this move in Bitcoin? That's when you know it's probably too late. I think as of right now, it's still like the beginning stages of this breakout. You're just hardly getting over the trend line. Some people would argue that you might want to wait for the break to take out the high and make a new all-time high. Regardless, again, not that we're Bitcoin maxis, not that I'm a crypto bro, but the opportunity here does seem like a solid one, and that's just sort of a little segment today on Bitcoin. Let's move along to market breadth. So we've basically covered that it's a risk-on indication here out of crypto. Market breadth has also improved this week. You can see an uptick here and an uptick over here. Let's take a look out of the RSP. This is certainly looking fine. The non-weighted version up here hanging out near those highs as we're consolidating and balancing off in the market. Once again, not an issue from a breadth perspective. Equal weight Nasdaq is almost identical to the weighted Nasdaq, so all set on that. I want to continue to point out that the Dow Jones transports have broken out of this multi-year balance range, and now it's all about this retest holding a higher low over the 16,150. If that's the case, then this really would speak to improved breadth and once again probably act as a bullish tailwind for the S&P, or just general sentiment would be, hey, even if the market cools off a little bit and goes sideways, it's probably not a short, right? If transports are holding up over this big breakout level, confirming the move that we're seeing here in industrials. Now let's talk about volatility. As I was mentioning a little while ago, volatility actually is cooling off this previous week. As this market balance has taken place, you can see that we're pushing in the downward direction here out of vol. I think that it could easily come back to the upside depending on what happens with the next labor report, which as we know is 2 Fridays from now, not this upcoming, but the one after that. And generally speaking, I still think volatility will remain elevated prior to the election, right? You can even take a look here at the VVIX. It's still, generally speaking, over these lows. It's not nearly anywhere close to the comfort zone and complacency zone at 75. And if you take a look at volatility futures pricing in the November contract, yes, there's a sharp move in the upward direction getting you closer to a contango, but technically speaking, you are still in a backwardation underneath the zero line. Don't worry about those terms. Basically, all it means is that there's more risk in the November contract than there is in the December contract. Once again, pricing in some election uncertainties. That's what you're seeing there out of those volatility futures. This is a contango, which is healthy. This is down towards the zero 1 day vol. That would be incredible. This is actually, it probably wouldn't be for day trading, but it's down towards its healthy zone, which is more bullish than bearish. You get more concerned when and if you start breaching up here and holding over 1275 as a floor. Let's jump on into the core list of companies here and see exactly what's going on from this perspective, beginning with Apple. Apple's been kind of a dark horse coming out of the background and really pushing in the upward direction here from what originally was, oh my goodness, iPhone 16 sales are so underwhelming, everybody hates the phone, to all of a sudden China demand sales are through the roof, up 30%. That was the headline on Friday, causing this massive gap up. it's just all over the place. But regardless, it is making a strong stand in the upward direction. I would really say that the Wednesday hammer off of the 229.50 is holding as a daily higher low over the top end of the balance range. As of right now, consolidation up here. It's blue sky breakouts. That's really what you're looking for. Higher low Brigade bolts up and over this zone. The all-time high is technically 237.49. Hourly chart's not really going to tell us anything new. It's kind of, honestly, like I'd prefer to see a stronger gap close all the way for a stronger retest and entry around 233. If I could spot this entry, I would entertain the longs back towards the upside. Really wouldn't short Apple. If it is going to turn into a double top, let it happen. Let it fall underneath 229.50. No need to jump the gun on that formation. Next up, we've got Microsoft. It can't get out of its own way, so I really don't think there's anything to be aggressive on here in terms of trading early on in the week. It's tangled up at the moving averages. It's inside of a balance range. If you take a look at it on the hourly time frame chart, couldn't break and stick above. I mean, even with the gap up, second chance opportunity couldn't make it happen. Third chance opportunity couldn't make it happen. But let's take a level-headed approach where the seller's able to make it happen down here for this. Absolutely not. So be my guest if you want to trade in this range, but at this point, Microsoft's a nothing burger. Let's take a look at NVIDIA. I think the daily chart looks great. You're continuing to push out of the trendline break. Bank of America giving it a, quote, I literally quote, generational buying opportunity out of NVIDIA, literally at the all-time high. I don't know how you could dare write a headline like that, but hey, if they want to hire me to write headlines, the contract will be massive. It'll be millions, if not billions of dollars for my time. But if we're just getting this consolidation up here, and I'll write better headlines than that, you can guarantee it. If we're just getting this consolidation, then, maybe Brigade bolts into blue sky territories. If it pulls back, any sort of consolidation pre-earnings, as long as we're over this pivot, it's just building a block in the upward direction. Nothing bearish to say about NVIDIA until you're under 129.50. Here it is on the hourly. I'd say similar to Apple, it'd be really strong if we got a better opportunity to long this off of 136.25, holding that Monday low. And also the gap fill reversal high of the Wednesday session. We're just not there yet. It's been a very slow grind. So what's the consensus? I mean, you just don't have stronger sellers here. They're not showing up in NVIDIA. So consolidation, and again, Brigade bullets to blue sky territories, probably the preferred outcome out of NVDA. Next up, Google. Very similar to Microsoft in the sense that it just can't get out of its own way. I'm at a loss for words. I really think it's a patience play. You've got to watch for this, and then maybe over time it's the full gap close up here. I know it's dim on your screen, but 180.150 is this earnings gap close from in the past. And if it breaks down, I don't really even think I maybe would trade this as a short into 156.50, but I would not be an aggressive short there. I would really still lean on the opportunity for inverted head and shoulders if this does break down, something that does this over time. And as we know, that 169 top of the balance that we were just talking about is still the neckline. So Google is really something to reserve for the higher time frame charts. If you look at it on the hourly, just it can't figure out this level for the life of it. Maybe a lower high on Friday underneath, but would you want to be short here directly into support, right? Support. Probably not, or at least I wouldn't want to be. Next up, we've got Amazon. What else is happening here with Nancy? The story of this chart is fantastic. I've been saying this for what feels like weeks at this point, but it just can't get in gear. So the story overall, and apologies if you've heard me say this now a number of times, but generally, previous resistance acted as support. You got a little bit of a double bottom. You broke out over the neckline. You held that. And now it just can't accelerate up and over the sort of Brigade bolt highs, right? You got a hammer here, an inside hammer here. On Thursday, a higher high, higher low hammer. And then on Friday, an upper wick that looked over these highs but couldn't accelerate. So the story still makes sense to me. I like the fact that you have lows, higher lows, especially at previous resistance, now acting as support. I like that you're over this balance range, continuing to use that as support, but just no follow through in the upward direction here out of Amazon. So taking it day by day, if we look at the hourly time frame chart, I'd like to think that maybe this is going to be constructive here, but that upper wick did technically close underneath 189.25. So if we're here, maybe it's a Brigade bolt over Friday's high, give you that level. That's going to be somewhere around 190.50. Let's pop that on real quick. Over 190.50, you've got this minor level, but really it's back up towards the top here at 195.75. So, if you could pick off risk reward that might look something like this to traverse that range, that makes sense to me, but I don't know with that close back down on Friday underneath the level at 189.25. So one day at a time, I'd like this consolidation. I would like this trade. But if it falls underneath, just sort of have to treat it for what it is. Consolidation building out technically a constructive block. I mean, we can't be bearish there. It's a building block in the upward direction. I would be bearish if we lose support and maybe this acts as like a double top. We're just not there yet. Next up, we've got Metaverse. What's going on with Zuckerberg and his not so fantasy land anymore? He's making it a reality. 3-bar consolidation, equal lows, looks like a flush point. Now, do you want to short this? It's possible, right? You could short this and, through the equal lows, something that does this, but just understand the context of Meta, right? Nobody should lose sight of this. Maybe you're getting a little bit of a double top, and yes, the consolidation is underneath the neckline, but generally speaking, the weekly trend is massive here. The daily strength has been pretty incredible as the market's been pushing higher, really, especially on these days back here, the original breakout. So if this breaks down, I mean, you could short this for a Brigade bolt into 561. That's possible, but I would really start to think harder about pullback longs here instead of big time shorts, right? Keep in mind, earnings will not be, they're certainly not this week. We just saw Tesla is the only of the Magnificent Seven, but the week following that is going to be the all important sort of Magnificent Seven core group. You're probably going to get Microsoft, Meta, and Amazon same week, maybe Google instead of Amazon rather, and then you'll get discretionary Amazon and Apple later on. But generally, you get the idea. If we can sort of get this pullback pre-earnings, maybe, but I would really be more inclined to say, where's the pullback long and not try to short it, right? I think there's a better long opportunity than short entry. Next up is Tesla. As you can see, I've got an alert on the chart here at 222.81. Just generally, if we can get back up over these wicks, it's a gap close overhead. Earnings are on Wednesday after the close, so please keep that in mind. Options premiums will get a little bit funky. It's very possible that you just go out in time and buy an expiration that's not going to be impacted by the earnings cycle. So that's a possibility here, but generally speaking, there's nothing to do on the short side. I'm really just interested in this trade here out of Tesla. I would not want to be a big new money short into these lows, 200 SMA is sitting down here. I don't think that you're going to get a really powerful, move to the downside that would make it worth your while. I think that this is easier to manage risk because the levels are so well defined, right? Risk and reward back to the upside. No need for the hourly chart there. It's just sideways in the multi-day consolidation. JP Morgan Financial is really strong, back to all-time highs here out of JPM. It's kind of lackluster near the literal all-time high from back here, but if we look at the hourly chart, I mean, it starts to look a little bit like an ascending triangle, maybe a little bit of a rising wedge. So I'd keep it simple here. If we're over 224.75, it's just got to be a blue sky territory drift higher. If we're underneath, I would not short this until there's a lower high under 220.225, noting that you would, of course, have already broken the trend line, but more importantly, you're back down underneath and into some of the thin structure. So 222.25 is that key level if you are looking for shorts. Next up, Netflix. I think it's time to get back on a mind of its own, right? One thing that you'll note about Netflix here, looking back through the chart history, we can even grab more than just a year. Let's go back 2 years here. So it really begins with this cycle here. After earnings, mind of its own. A little bit lackluster in this one, but mind of its own. After earnings, mind of its own. After earnings, mind of its own. Same thing here. It's very possible that, especially as we're headed towards blue sky territories, there's nothing overhead for resistance. It's very possible that this goes for another run in the upward direction. Just keep in mind that the last two examples of this, it's a very short-lived rally before it starts to get a little bit grindy, right? You had maybe 3 or 4 days of aggressive upside consolidation one day, so you would have had to nail that actual day. Maybe 3 days in here, you would have had to nail those 3 days. So just understand that. In here, you get 2 days of breakout, gap fades, 3 days of breakout, then consolidation for a long period of time, right? So you've got to be somewhat precise. If this is day one of the move in the upward direction, it's possible that you get maybe 2 more. A day of consolidation ideally does not make a new high, and then we buy it. And again, this is not a recommendation, but from a trade setup perspective, it would probably be more bullish than bearish if you get inside consolidation, then go on to produce a new higher high, something that looks like that. So really simple chart here out of Netflix. No need to overcomplicate it. You could take a look at this level right here and just say anything over 760.50 looks for continuation. Anything under 760.50 looks for consolidation. And then ideally, we get something like that for blue sky breakout. Next up, we've got AMD. What's going on with AMDizzle? This stock has been just relatively weak compared to NVIDIA, so understand that from a semiconductor perspective. You want to be trading the strongest names. Right now, that's TSM, it's NVIDIA, it is Broadcom even. It's not AMD, it's not Micron, it's not Qualcomm, it's not SMCI. Those semiconductor names are sort of taking a backseat. So just keep that in mind when you're choosing what you're looking for. If you're looking for shorts, then yeah, absolutely, AMD is the place to short. If you're looking for longs, you probably want to move over to NVIDIA, right? So just a multi-day range, but the point of the analysis here is just that this previous pivot high is not continuing to act as support. NVIDIA bounced right off of it and is trading at all-time highs. AMD certainly broke through that and is trading below. It's rejecting and accepting underneath. Even on TSM earnings, when it opened on the gap up over the level, no support above the level for a rally, no support for a gap fill reversal and rally. You can see it just faded off into the end of the week here. So understand that AMD is the weakling of the bunch. I would be looking for bear flag consolidation and ultimately continuation to the downside. 153 maybe moves to 149, and we can look for one more target to the downside together just so we're prepared this week. What do we have through this thin structure? Oh boy, this is getting a little bit juicy down here. Some thin structure retracements down towards 139 could potentially be in store, right? Just look at this thin structure. I mean, maybe you could make the argument that you have this as well, 142.15. We'll throw that on. What I'm going to do is just make it one of those dimmed out and dashed levels. Let's do that together here. So not unreasonable. I mean, it's a decent level to be watching, but, you know, just based on if you wanted to call this inverted head and shoulders neckline. But really, it's these shoulders that I would watch, 139. So again, the call is not that we're just going to like, you know, break to the downside, oh my goodness, 139 in the blink of an eye, but it is more bearish than bullish here out of AMD, which I do think is noteworthy. All right, a couple of trade ideas for you. The first one is on WMT, which is really just a reminder trade idea from what we had talked about on Wednesday. Let me zoom in over here on the right. You can see we've still got this multi-day consolidation. You've got sort of an ascending triangle if you draw on a trend line that looks like this. The reason that Walmart is somewhat worth watching is because, first of all, this is blue skies if we break out here over the ascending triangle, but also it's just not even related to the semiconductor space. So if you need longs, if the broad market, specifically the S&P 500, is staying bullish and, you know, the broad market strength is really carrying in the upward direction, Walmart's a possible place to look for a long. The options chain is, it's okay ever since the split. It's not as good as it used to be. It's a slower mover, of course, now, but something worth watching. Walmart, that's a reminder trade here. Next up is TTD. The trade desk is a breakout to blue sky territories. This is a little bit more technology related, of course, but up and over these highs, the reason I wanted to point this one out is blue sky territories, first of all, but the reason I wanted to point this out is because look at Friday's bar. It's a green-bodied hammer-esque candle, but please, let's read into the upper and lower wicks. It's an engulfing bar to some degree. Now, you didn't open underneath the previous low and you didn't close over the previous day's high, but put yourself in the shoes of a seller. You have multiple days of consolidation. You breach the previous day's low. You breach the low of the extreme of the consolidation. And do you find acceptance underneath that? Absolutely not. You rallied to close basically back up at the top of the range, and you even tested above the range. So are stronger sellers in TTD? Probably not. If this can poke through and hold above 118.80, it's just a blue sky breakout. Here it is on the hourly time frame chart. You can see all of that volatility is mostly produced in the first hour of the day, where there's that push below. Sellers absolutely get flattened, and here we go. Possibility for a blue sky breakout in TTD. Watching out for that. The next two trade ideas are a little bit thematic, and I want to say a huge shout out to Tom over at Walks in Wall Street. He puts together a great, fantastic newsletter. It sends every other Thursday, I believe. You can check out his channel. It's Walks and Wall Street. But Tom and the crew and everybody in the chat, it's really a great community over there. He streams most nights after the market closes, later on, like 9 p.m. Eastern time. Shout out to Tom. But we've been having this conversation, and Tom has really been the spearhead of this conversation. So please, again, all credit where credit is due. We've been talking about the possibility of nuclear energy, right? And nuclear energy fueling AI data centers in the future. So, and we've seen comments about this online, and people are talking about it. It's a general idea floating around in the marketplace right now. So let's look at two ETFs. URA is the first one, uranium. This is the global ETF here for just straight up uranium. And we can see that really, let's go to a weekly chart. Let's start with a higher time frame. The trade has 100% retraced this move off of the weekly 200 SMA. I think that this is also a very technical move, right? You're seeing previous rejections in the top of this range act as support. You've seen this act as a double bottom. And typically what I'm trying to get at here is that when you have a 100% retracement of a move like this low is oftentimes fairly secure. I would say it's highly unlikely that you trade all the way back down to that area. Now, that doesn't mean just buy this long up here, up and over the highs. Let's see if we can get a maxed out chart. When was this produced? It's been around for a long while. But you are getting this rounded base, a next stage 2 base. Is it possible that, clearing these highs starts to get you into something like, I don't know, up here around, just shy of 50, 46 or so from the closing price at 33 as of last week? Generally just nuclear as an idea for, the power behind AI. We can all talk about like, okay, AI and what are the benefits down the line? How's it going to improve productivity? What new types of jobs are going to emerge when AI is like in the full swing of things? What's it going to do for GDP? We could talk about that, but how are we going to fuel AI? What's the infrastructure going to look like, right? So uranium, nuclear is a possible idea. So the first ETF is URA on a weekly time frame chart. Here you have it. Looks decent for a stage 2 base, trying to break out here, move back in the upward direction. 100% retracement as we just saw. Again, the daily time frame chart, I wouldn't read into it too much. I think that buying up here at the extremes of this breakout high, I don't know. That's typically not good. That's not good form. It's poor form when it comes to trading. You never want to be the suckers long. You would wait for some sort of like high or low pullback, or, break through the resistance and then pull back above the resistance for a stronger entry point. So those types of ideas come to mind. And then the next ETF is still uranium related, but it's NLR. This is a Van Eck. Uranium and nuclear. You can see it looks similar, but we're already over this previous high, right? So this boom taken off in the upward direction, just like what we saw on the higher time frame. We want a max of it. Come on, Thinkorswim. Want a max available chart here. And we'll just take a closer look. So you get this long-standing base. You're starting to accelerate out of it. Don't ask me about what this was over here. Did not do the full research out to that bit. But notice that you're just clearing this, right? So what was the next logical resistance? Probably somewhere up here. I don't know if this is a true gap. I don't know what kind of wonky activity is going on with that. But generally speaking, the technical picture looks decent. Breaking out of this long-standing base. Nuclear is really a new... I shouldn't say new. It's not a new idea, but it's more so being reinvigorated with this push to AI. You're seeing deals from Microsoft investing in AI. You're seeing deals from Google. I wouldn't be surprised if Amazon has something in the pipeline. So generally speaking, that is a final segment here. The last two ETFs in the trade idea world is going to be URA, uranium ETF from Global X, and then you have NLR, which is Van Eck, uranium and nuclear. This is not a recommendation to get into any of these. Again, you've got to do your own research. You've got to see if it's right for your portfolio, but they're just thematic ideas to start considering as we move into this next era of AI and what it means for the entire economy. So that is going to do it for today's episode of the weekly watch list video, the Saturday update video. If you enjoyed it or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Reminder, we will be live every single day this week for our pre-market prep. Kicks off at 8 a.m. Eastern time every day live here on the channel for your pre-market prep. Get ready for the day. See the levels that are in play, what trade ideas are really coming to the top of mind, and then, of course, enjoy yourself a coffee and donuts when the time is appropriate up in the penthouse office here with us. With that said, have a green trading week, and I will see you in the next one.